Alright, here we go. First thing, I just sent out my EIA Weekly Petroleum Report Analysis. Sent that out. There was a 7 million barrel build in crude oil inventories, but you know, the market initially sold it off. The zombies sold it off, like I always knew they would. By the way, in my zombie report, Zombie Trading, which is my Forex signal service, I said sell Canadian dollar because the zombies were going to sell oil, but make it a quick profit, and that's what it was, because oil comes bouncing back. Why? Because there are other things in that report that were bullish. Other things in that report that were bullish. Now I say this every single week. You get people who sit around and they wait for that report and they see one thing on there. They see crude oil inventories, or maybe if they think they're smart, they see gasoline inventories and they react on that. And that is like handing money to me. You see, that is like handing money to me, because there is so much information in that report that if you are one of these people who are just sitting around waiting for that one inventory number and you think you got some kind of handle on the oil market because of that, then you are literally handing money to me. Because you have to know how to look at the things that are very relevant in that report, and you have to be able to synthesize all that information. I send that out. So we had that, and you're seeing oil prices bounce back. Basically, we had very high exports of product. We had drawdowns in product inventory. Imports are still at a 5-year low. They were at a they're at a 23-year low if you look at just the week to week, the nominal numbers. But if you look at the 4-year average, they're at a 5-year low. So there's a lot going on in there. Gasoline demand jumped up again. There's a lot going on in there. You have to be able to synthesize that information. All right, that's number one. Number two, we saw the trade deficit today for the United States come out at the widest it has been in 11 years. The U.S. trade deficit is the biggest in 11 years. Now, I said this way back when Trump first started to engage in these tariffs, putting the tariffs on. I said the tariffs were going to have the reverse effect initially. I didn't think the tariffs conceptually was a bad idea, and I know everybody went crazy with the so-called trade war. I was not one of them. I never thought that was a danger to anything, because it's not a war, it's a redistribution of product and income. All right? China, which was exporting product and getting income, would now be getting more product and less income. And the United States, which was getting product and exporting income, would now be getting less product and more income. So product stays the same, the real output stays the same, the real income stays the same. It just gets redistributed a little bit. It's not like the real product goes flying out into outer space or gets destroyed. That wealth is not destroyed, nor is the income destroyed. It just gets shifted around a little bit. So there was never a reason for the markets to react in the fashion that they did, and as a matter of fact, every time they sold off in this crazy, hysterical fashion, I told my people to buy, and that was the right thing to do. Now, why is it happening? Shouldn't the tariffs have led to a narrowing of the trade deficit? And I talked about this a long time ago. When he first started to do it, I predicted this. I said, here's the reason. Because capital investment in the U.S. has been declining over the last 20 to 30 years, capital investment outside the U.S. has been rising. In other words, U.S. firms have been investing more in production outside the United States, right? That's what's been going on. Production in China, production in Taiwan, manufacturing all over the place. So the ability to quickly shift that productive capacity or that manufacturing from external, from outside the United States, from the rest of the world back here, was almost impossible. Our facilities, our plants, our manufacturing capability was not up to the level of what was in place in the rest of the world, simply because if you look at those investment flows, they have been external rather than internal to the United States. It was going to take time, and every single month I was posting up, or I was sending out to my subscribers, showing them how capacity utilization, industrial capacity utilization in the United States was flat, despite the tariffs. We did not see even the slightest blip up in capacity use. Why? Because you just couldn't. It had to be built. It had to be brought up to standards. It had to be made competitive to what existed outside the United States. Now that's going to happen over time if these measures like the tariffs and everything like that stay in place. That'll happen over time. But it was not going to happen immediately, and that is the reason for the trade deficit, the very large trade deficit. Now the quickest way for this to happen is for the dollar to fall. This would incentivize manufacturing being brought here in the United States. It would make it cheaper for countries and firms outside the United States to come here and invest in plant and equipment and all that stuff. We'll have to see. But one thing that complicates the dollar fall scenario, and you know I've been short the dollar, and I've been short the dollar since the Fed started raising interest rates in 2015, but they stopped raising interest rates this year. They came out and flat out said it, we're not raising interest rates anymore, and the dollar has been strong as a result. And another interesting thing, that since the Fed said they were ending their rate hikes in January, what's been happening to gold? It has been going down. Exactly as MMT describes, exactly as I have been telling you. Now most people thought, oh, gold's going to take off because they're ending the rate hikes. No, it went down. Just like gold started to go up the minute they announced they were going to start raising rates in December 2015. Gold was at $1,043 an ounce. They started raising rates. It went all the way up almost to $1,400, and that's been bouncing around. Actually, the give back in gold over the last year really came about when there was starting to be a rising expectation that the Fed was at the end of its rate hike cycle. As a matter of fact, that's when the dollar really started to take off too. When the market participants started to feel that the Fed was near the end of its rate hike cycle, and actually a number of Fed members, FOMC members, were echoing that sentiment, and that created the bullish impetus in the dollar and the bearish impetus in gold. The Fed came out and established that in January of this year. We were done raising rates. We're done raising rates, and as a matter of fact, they're going to say this month in their meeting this month that they're going to end balance sheet runoff sometime later this year. That's also bearish for gold. That's bullish for the dollar. That is probably somewhat bearish for the economy, but we have time for that. So everything as MMT describes it, everything as MMT describes it, the trade deficit is completely understandable, and I talked about it a long time ago. So that's where we are right now, and let's see what happens with this U.S.-China trade deal, and you know, that could play in as a factor as we go forward. But right now, monetary policy has changed. Let's face it, monetary policy. And by the way, not just with the Fed. You see it everywhere now. Bank of Canada today saying, we don't know anymore about the interest rates. Australian Central Bank, we don't think we're hiking rates anymore. Bank of England, Japan, forget about it. ECB tomorrow. They might even announce new stimulus, what they believe to be stimulus, which is loans to banks, which is a terrible idea. A terrible idea. And one of these things, one of these monetary policy actions that just is deflationary and slows everything down. So we'll see what they do tomorrow. We'll see what they do tomorrow. All right, see everybody later. Bye-bye.